How are investment decisions made in a market economy? Have you ever wondered how investment decisions are made in a market economy? It's a fascinating process that involves many players and factors. In a market economy, investment decisions are primarily made through a decentralized approach. This means that individual investors, businesses, and financial institutions make their own choices about where to allocate capital. They base these decisions on expected returns and risks. Market signals play a key role in guiding these choices. Prices, interest rates, profit opportunities, and various economic indicators all influence how investors decide to invest their money. Investors aim to maximize their returns by looking at potential profitability, market demand, competition, and risk. They often use financial tools like net present value and risk analysis to help guide their decisions. Let's break down how this works in more detail. First, there is the profit motive and competition. Investors tend to put their money into industries and projects that promise higher returns compared to other options. Over time, competition among investors helps equalize rates of return across different sectors. If one sector is more profitable, capital will flow there, leaving less profitable sectors behind. Next, we have decentralization and individual incentives. Unlike a command economy, where a central authority makes investment decisions, a market economy relies on many individuals and firms acting in their own interest. This decentralization allows for flexibility and responsiveness to changing economic conditions. Economic signals are also vital. Investors look at indicators like gross domestic product growth, inflation rates, interest rates, and political stability to gauge the investment climate. These signals help them understand the cost of capital and potential demand for goods and services. Risk assessment and financial analysis are crucial steps in the investment process. Investors evaluate financial performance, management quality, market potential, and legal factors. They use structured methods to analyze risks and ensure their investments align with their strategies before committing funds. Finally, capital mobility is a defining feature of a market economy. Capital can move freely in response to profit opportunities. Entrepreneurs and investors can enter or exit industries based on expected returns. This mobility promotes efficient resource allocation and innovation. From a socialist perspective, this market-driven approach is often critiqued for focusing more on private profit than on social welfare. Socialism advocates for more collective or planned decision-making in investments. This approach aims to ensure that investments serve broader social goals, like reducing inequality and providing public goods. In summary, investment decisions in a market economy are shaped by a decentralized process driven by individual choices, economic signals, and the pursuit of profit. Understanding these dynamics can help clarify the differences between market economies and other systems, such as socialism and mixed economies.